You may have heard the term capital gains, but exactly what are they? Well, here to talk with me about that is CJ Miller from Sensible Money. CJ, welcome.
Hi, Bob.
Good to have you, CJ, because we need to have capital gains taxes explained. Where to begin?
Well, I think the easiest place to start is what is a capital gain and why does the government make you pay a tax on it? So anytime that you purchase a security and then sell it for a profit, that's considered a capital gain. And unless it's held in a retirement account, like a 401k plan or a Roth IRA, the government comes in and says, well, we want our piece of that profit. And that's where the capital gains tax comes in. And so it doesn't even have to be in a financial account. If you buy baseball cards and you sell them to your brother and he pays you an extra $1,000 for them, well, technically you're supposed to claim that $1,000 as income on your tax return.
Right. It applies to crypto too, I'm told.
Yes, there are some big tax liabilities coming from those that got lucky in the crypto market, that's for sure.
Right. Now, when it comes to capital gains, CJ, there are two types, short-term and long-term. What do we need to know about that?
Well, that all depends on how long you hold the security for. So, really the government is trying to incentivize that you buy and hold securities for a longer time for long-term investment. And so because of that, if you hold your security for longer than 1 year and 1 day, then you qualify for what is known as a long-term capital gain. And those are taxed at lesser rates. Now, if you buy a security and then you sell it in 20 days, any of that income is going to be taxed identically to ordinary income. And so you pay the traditional tax rate on it.
Right.
And, the long-term gain rate can save you a lot of money. So, there's a 0% marginal rate, which means you pay nothing on those long-term gains if your income's low enough. And then there's the 15% rate, and then the 20% rate is the highest marginal rate. And then there's a surtax on top of that in some cases, which would be technically an effective tax rate of 23.8% on a lot of those capital gains if you're a high income earner.
Right. So obviously, capital gains tax is different from ordinary income tax.
Correct. Yeah, particularly just because of those rates. And so, if you hold those long-term capital gains and you sell them, maybe your ordinary income rate is 24% at a marginal level. You might only pay 15% on the long-term capital gains. And so inherently, it's different for that reason.
Right. So you mentioned capital gains. You can also have capital losses.
Yes. And so because the government wants to take their share of the profits, they also allow you to offset any capital gains with losses that you experience if you don't get lucky. And so let's say you make $10,000 on one stock, and then you sell another stock for a $5,000 loss, you can offset part of your $10,000 gain with that loss. Now, what the government doesn't allow you to do is take all of your capital losses and offset them against all of your ordinary income. So let's say you don't have any capital gains, but you made a bad business investment and you have a $50,000 loss, a capital loss. You can't take that $50,000 and apply it all to your tax return. They only let you deduct up to $3,000 off against ordinary income each year, and then you have to carry the rest forward. And so if you have a $50,000 capital loss carry forward, you'd slowly use $3,000 a year against ordinary income or offset other gains along the way with that until it's fully used up.
Right. And I don't necessarily want to get into the weeds, but you have to balance your short-term losses against your short-term gains and your long-term losses against your long-term gains.
Yeah, I usually leave that one to the CPA and the tax calculation software. So if you get your 1099s in order and you consult with a qualified tax professional, they'll work all that out for you.
Right. So talk a little bit about the strategies that people can take advantage of with respect to capital gains tax rates.
Yeah, well, there are a few ways to take advantage of the lower rates. A common one is that if you have a long-term portfolio that you've been investing in a long time, instead of selling a large amount of the appreciated assets at once, spreading out the sale of those. So for instance, if you had an S&P 500 mutual fund for 30 years, well, you've probably got some, a large amount of embedded capital gains that are unrealized. And so you could sell it all and, pay up to 23.8% on most of that gain. Or you could every year project your taxes and say, well, I could realize 30,000 more in gains this year at a 15% rate and try to fill up that bracket. Another common strategy that we're seeing employed is installment sales in businesses. So if you are a business owner and you sell your business all in 1 year, well, that's a pretty big windfall. And it's nice to have that cash up front. There's less risk there, on the sell side, but you have to pay a high capital gains rate. Whereas if you structure the sale of your business as an installment sale over, say, 5 to 7 years, and you take, payments quarterly or annually, the capital gains burden gets spread out. And so you might only be taxed at 15% for most of the business sale.
What about tax gain harvesting? That's another strategy that people need to know about.
Yeah, and this is primarily for your low income years. So I mentioned there's a 0% capital gains tax rate. If you're in between jobs or you have a medical shock event that results in a large amount of deductions for a given year, you may be able to actually realize gains in your portfolio. So you sell a particular appreciated asset, even if you want to reinvest in it that day, you don't want to stay uninvested. You can take the capital gain, pay 0% in tax on it, and then have a higher basis. So when you sell it again in the future, because you do need the money, you'll have less of a tax liability later on. So that's a pretty useful tool, but it does require some legwork to project out what your tax rates are and to identify that, hey, this is going to be a lower income year for me.
Right. And the opposite strategy is what? Tax loss harvesting?
Yeah. And tax loss harvesting is a little more complicated. It's not for everybody. But essentially the way that works is in a steep market decline. So let's say you get unfortunate and you invest your money on January 1st, 2020. And then, well, look, March 2020 comes and there's a big steep decline in the market. The way tax loss harvesting works is you sell, contrary to popular recommendation and advice, you sell after the steep decline, and then you buy another security that's not materially identical, so that you're still invested for the market upswing, but you've captured a large tax loss that you can then use to offset gains later on. So we had some clients do this in, the decline of 2020. And we had one client that had some commercial real estate in Chicago, and they were able to take their capital losses from the portfolio. We had them reinvested. So they received the rebound from the marketplace that we've all seen happen over the last 18 months. And they were able to sell those buildings in Chicago with very little tax impact because they used those losses to offset it. So it can be a valuable tool, but it is risky, right? Because you can end up doing it improperly, or worse, you can sell and then not get reinvested properly and miss any market upswing, and then you're taking a big loss, which you might not want to take.
And then folks who are involved in this world need to worry about the wash sale rule.
Right. And so the wash sale rule was designed by the IRS to cover this loophole. Because they don't want people taking a tax loss and then still getting the benefit of being invested. And so it was designed around individual stock and security trading originally. And so the way it would work is if you buy Google stock and then you sell it for a capital loss if Google stock declines, and then you go tomorrow and buy more Google stock in the same amount, they disallow that. They say you need to wait until 31 days after your initial sale if you want to take that capital loss in your return. And so they call it a wash sale. And when you get your 1099, that loss isn't going to show up on there. But where people can, I don't want to say get around it because, we're not trying to evade the tax rules here, but where the IRS has said it's okay to reinvest is in a security that's not materially identical. So let's say you buy an S&P 500 fund, and then you sell it at a loss to capture a capital loss. You can reinvest in a Dow Jones fund instead, that has a similar makeup potentially, and capture a similar market rebound without having that loss disallowed on your return.
Right. What do folks need to know about asset location of their investments with respect to capital gains?
Well, this is a great overall investment strategy in general, but it really helps amplify the benefits of those capital gains rates. So everybody reads about asset allocation, which would be, based on your age or your goals, your risk tolerance. We're going to say you need to be 70% equities and 30% fixed income, or 65-35, whatever that mix is. What a lot of people do is they go into each of their accounts, whether it's a Roth account or a pre-tax account, and they say, okay, I'm going to allocate all of my investments, 70% growth, 30% fixed income. What asset location does is it says, well, wait a minute. If we know these different account types are going to be taxed differently, then what we need to do is locate that allocation differently. And so, for example, the standard rule of thumb would be if your Roth accounts are going to grow tax-free and you're not going to have any capital gain tax upon sale of securities or withdrawal, you should put your high potential growth assets in there. So, things that you think will grow the most over long periods of time. So typically Roth accounts are going to be 100% invested in equities. And then secondly, right, we know that pre-tax accounts are going to be taxed at ordinary income. If you have gains in those accounts and you take the money out, it's going to be taxed at a higher rate than the long-term capital gain rate of a non-retirement account. So you want to put more of your fixed income in that account and less in your Roth account or your non-retirement account. And so it's just a way to look at asset allocation differently to take advantage of the tax code.
Yeah. Are there times when this rule of thumb doesn't apply?
Absolutely. So like any rule of thumb, right, it all depends on you being kind of in a box. And most consumers are not in a box. And when they build their financial plan, they have different goals. So one common example where you would say, well, I don't want to have all my high growth assets in a non-retirement account would be if you need money from that non-retirement account. You want to align your spending with your investments. And so if you're going to be withdrawing assets from the non-retirement account in the next, say, 2 to 10 years, you don't necessarily want that portion of money in a growth portfolio that's going to be highly volatile, just for potential tax benefits. We see this a lot with Roth conversion strategies. If a client has a lot of money in a traditional IRA account and they're going to have some low tax years, they can convert to Roth. But in order to do that, they need to take money out of their non-retirement account to pay the tax on the conversion. And so what we end up doing is having a little more fixed income in the non-retirement account because we want to pay tax on the Roth conversion, throughout those years. And so that kind of bucks some of the traditional rule of thumb with asset location.
Yeah. So one curveball to throw your way, CJ, there were news reports this year of folks who had invested in some mutual funds inside a taxable account and then were surprised at the large capital gain distributions that had occurred and for which they had not planned for. Any advice for folks who are investing in mutual funds in a taxable account?
Yeah, well, you certainly need to research the tax efficiency of those mutual funds. And certain mutual fund families will advertise that, but you really see big differences between passively managed mutual funds and actively managed ones. And not to get into all the weeds here, but essentially the difference is actively managed mutual funds tend to trade a lot more because they're trying to pick the best stocks and they have sector approaches that can change monthly or quarterly, whereas passively managed funds typically take a longer view of the market. So they're not selling and buying and trading as much. And so when you're buying and selling securities within a mutual fund, even if you as a consumer don't buy and sell any shares of that security, those capital gains do get passed on to you. And so we do see large differences and the amounts can be substantial. I mean, you could have a mutual fund that's passively managed, pay a capital gain of say $200. That could compare to an actively managed fund that could pay $1,000 in the same year with a very similar investment philosophy. So certainly do some research on that and make sure you get, just like a low expense ratio, a tax managed mutual fund.
Yeah. So we've covered a lot of ground, CJ. Anything we missed or anything that bears repeating or reemphasizing?
No, other than, hire a tax professional when you need to for these things and make sure you pay your capital gains tax because it'll come back to bite you if you don't.